The S&P 500 finally broke through the psychological threshold of the 2,900 level on Friday. As of the close of last week, the blue chip index ended less than a percentage point below the all-time high set in 2018. As the domestic market continued its trek back towards all-time highs, it has done so in an ever tighter daily trading range. In fact, the 5-day average trading range has returned to the lows not seen since September of last year, when the market hit its all-time high at 2940.91. In general, the domestic market has shown a sense of optimism ahead of the first quarter earnings results. Of the major markets, only the more concentrated 30-company Dow Jones Index closed lower on the week as it fell victim to the poor performance of a couple stocks. Wednesday's release of the March FOMC meeting minutes reaffirmed the central bank's plans to hold interest rates steady for the foreseeable future. The minutes highlighted growth concerns, stating that several participants noted that various indicators of inflation expectations had remained at the lower end of their historical range, and that the information received since the committee met in January indicated that the labor market remained strong, but that growth of economic activity had slowed from its solid rate in the fourth quarter. The equity market largely ignored this continued accommodative stance, while Treasuries experienced the largest drop in rates for the week on the news. Despite the dip midweek, the 10-year Treasury yield has continued to rise the last couple of weeks. The 10-year exited its inverted position relative to the shorter-term rates earlier this month. However, the 2, 3, and 5-year yields remain below shorter-term rates. And finally, the ongoing Brexit saga continued last week as the EU approved a delay of the Article 50 exit by the UK to take place on Halloween of this year.